Mike, it's always good to have you on earnings day. Welcome.
Thanks, Sarah. Thanks for having me again.
So just wanted to get the top and bottom line miss out of the way, first of all, even though the stock is reacting to some of that better guidance and just the overall enthusiasm right now around banks. The miss related to equity investments. Explain that.
Well, earnings decline primarily related to our cyclical businesses, having, coming into the quarter with headwinds against them. Both the mortgage business, as rates have really impacted that in a really substantial way over the last 2 quarters. And then, as you said, our private equity and venture businesses. And given what you're seeing in the public equity markets, that has an impact on the valuations there. But when you really look through that, as you mentioned in the lead-in, both rates and higher loan balances are really helping propel net interest income growth, not only in the quarter, but as we look at the full year. And so that should really help us as consumers are continuing to be out there spending. We're seeing, good activity across both the consumer and commercial portfolios. And I think that really bodes well for the environment we're in right now.
Right. It does hurt the mortgage business, though, as you mentioned. And as one of the biggest home lenders in the country, Mike, wanted to gauge how you're thinking about what's going to happen next and how bad it's going to get for housing.
Well, it's really, a function of rates going up over the last, couple quarters. And that's really impacted the refinance volumes that we've seen in the mortgage business as they've slowed as rates have gone up. We've seen a little bit of weakness in the purchase market, as rates have gone up, but that's still, has some good activity to it. And so, as I said on the call this morning, we do expect it could go down a little bit more in the third quarter, and then look to stabilize over the next couple quarters. And there really are some positive parts of the housing market too, where there's still the demand and supply imbalance across there. We're still seeing good home price appreciation. And so there are some positives to it as well, but it'll take a couple quarters to really stabilize. But again, when you look through the consumers there that are impacted here, we're seeing really good credit performance still, very maybe slightly off of low levels historic lows that we've seen, but really good performance across all the portfolios, and I think that really sets us up pretty well as we go into the uncertainty that's there in the environment.
But Wall Street is very nervous, Mike, as you know, about recession. So you're saying you're just not seeing it, or you're not seeing it yet?
Yeah, well, we're certainly not seeing signs of stress yet, across really any of the portfolios that we have. But we know as rates rise, and the Fed has been pretty clear about what they're trying to do in terms of stemming inflation, that will have an impact on growth, and that is going to have an impact on not only the economy, but also consumers and businesses over time. I think you'll see that first in the low-income, cohorts across the consumer space. Not a big, piece of our business, but I think that's where you're gonna see it first as the impact of inflation really, takes hold there. But you sort of have to look through these environments, and we're continuing to execute on the things that are our priorities around building out new capabilities. We've launched new credit cards. We're seeing good uptake in a lot of that. What we're seeing, we're executing on our efficiency plans, and so really our focus is to stick to the things we can control and make sure we manage all those risks that are out there.
Right. No, the credit card business, I think, was a highlight. You've seen strong spending, and what about delinquencies, Mike? Any signs that's picking up?
Not in our portfolio. I mean, very, very small ways, but still very, very much below where they were pre-pandemic. And so, and as we launch our new products, we're seeing really good uptake, but we're also seeing really great credit quality, as in terms of the customers that are both applying and getting approved for the new products. And so, all that's actually working quite well. We're not seeing that in the card business in any substantial way yet.